And now let's take a look at some business news. The head of the UK's central bank says inflation will prove hard to pull down amid a so-called wage price spiral, locking in higher prices. Bank Governor Andrew Bailey said on Wednesday that higher prices carrying over from last year's pandemic, reopening and energy price shocks are at risk of getting worse. That is, as a lack of workers is forcing firms to offer higher wages to try to fill open vacancies. But that is contributing to a so-called wage price spiral. That means more money for workers result in higher prices for everyone, worsening the cost of living crisis. The Bank of England's target inflation is 2%, but the current rate is still more than 5 times that, despite hiking interest rates 12 consecutive times. And now to other top stories from around the world. Tencent has posted the fastest jump in quarterly revenue in more than a year. The Chinese tech giant's revenues rose 11% to $21.4 billion year on year. That is as payments volumes, ad sales and gaming rebounded with the easing of COVID-19 restrictions in China. It marks a return to growth for Tencent, whose gaming business has faced intense regulatory challenges from the Chinese government. Deutsche Bank has agreed to pay $75 million to the victims of convicted sex offender Jeffrey Epstein. The payment is part of a settlement to resolve a lawsuit filed against the bank accusing it of enabling and benefiting from Epstein's trafficking of young women. While Deutsche Bank has reached a settlement, JP Morgan Chase still has a lawsuit pending against it in a Manhattan court involving similar allegations. And Sony says it is considering a spin-off of its financial unit, Sony Financial Group, in the next few years, which will operate life insurance and banking divisions. The separate listing would help raise funds needed to reinforce its entertainment and image sensor business. The Tokyo-based company's shares rose more than 7% on the news. Okay, now let's get more on our business top story. Joining me now is Josh Mahaney from London. He's a chief market analyst at Scope Market. So Josh, we have heard fears of a wage price spiral in the US and the European Union, but they never materialized. What is different about the UK?
Hi, thanks for having me on. Look, if you speak to the governor of the Bank of England, he'll say that the reason behind this big rise in terms of inflation has been twofold. Number one, the pandemic. Number two, the war in Ukraine, and of course, the knock-on implications that's had to Europe in particular. But the one thing that he misses out is Brexit. And certainly we have seen an increase in terms of the costs of sending goods into the UK, increased measures at the border. And that, of course, just adds an extra layer of friction at a time when companies are struggling at the moment anyway. So a lot of people find it difficult to send products to the UK that they used to very easily do so under the EU. I think that is the reason, one of the main reasons why we have that difference between the EU rate and the UK rate. Of course, UK inflation currently at 10.1%. So it's a big problem here at the moment. And this wage price spiral idea is born out of the idea that essentially, if we fail to push down prices, then soon enough, businesses take that into account, build it into their expectations. They, in turn, up the cost of goods because of the fact that they're paying more in terms of wages, and therefore you start again, and it keeps going over and over and over. So you really need to drive down inflation very quickly to stop that happening. And of course, the UK at the moment is in a troublesome position because of the fact that we haven't managed to do that.
Josh, is there any kind of regulatory mechanism that the Bank of England has up its sleeves to try to combat this spiral? We heard on their chief economist say that people need to accept that everyone is worse off, but doesn't that come with serious political risks?
Yes, those comments really do highlight the problem that the Bank of England are facing. They can raise interest rates all they want, but their expectation is that at some point is going to have a knock-on impact. What if it doesn't? What if the consumer is relatively resilient, as we have seen thus far, and people continue to spend, people continue to go about their daily businesses, businesses essentially continue to up prices or up wages because of the fact that they want to continue to do business, and people seem happy enough to pay this increased price. One of the areas that we have noticed, of course, recently is the fact that the Bank of England, alongside the IMF, had been forecasting a recession within the UK that we hadn't been seen forecast elsewhere within Europe and many of the other developed countries. That hasn't come to fruition, and more recently we have seen the Bank of England up their forecast in terms of growth and inflation. But really what this does highlight is the fact that inflation is born out of expectation. So they can raise interest rates and hope that that drives down economic activity and lessens prices. But also, they're essentially trying to set the precedent for the UK to be going through a very difficult period. If they talk down the UK economy, people might become fearsome or fearful around about their jobs and start to think, maybe I should rein in my spending. Maybe I shouldn't spend as much because I've heard that there's a recession around the corner. So these are just words. These aren't necessarily actions that the Bank of England are taking. The interest rate move is expected to have knock-on implications, but it's not necessarily feeding through at the moment. One thing worth noting, on the inflation front, we are expecting to see a significant drop-off in inflation this time around, just down to base effects. If you look back to this time last year, we did see a big rise in terms of energy prices. They will drop out. So we are expecting to see the beginning of a move towards a downside for inflation. But as we've seen for the US and the EU, taking that top level area off in terms of energy prices, that's the easy part. It's getting into those stickier parts of the inflation problem. That's going to be a lot more difficult. And certainly in the UK at the moment, your food price inflation currently significantly higher than many areas, 19.1 in food price inflation. So that's one area that's going to be a big problem going forward.